Good afternoon, everyone. Thank you for joining us. We're just going to give it a minute or so to let everyone in and numbers steady, and then we'll get underway. We will have a session at the end for questions. So if you do have any questions throughout the presentations, please just pop them in the questions box on your control panel, and we'll go through everything at the end. We'll just give it a little more time. Okay, I think our numbers have evened off, so we will get started. So good afternoon, everyone. Thank you for joining us. So my name's Louise, one of the partners at Larking Gowen within the medical team, and I'm joined by my fellow partner, Lizzie. We have our VAT guru, Gilly, also joining us today, and we're also joined by Rob from Mills and Reeve, to share the legal perspective on all things PCNs. So as I said, if you have just joined, we will have a session at the end for questions. So please do pop any questions you might have in the chat, in the question box, and we'll run through all of them at the end. But otherwise, I will hand over to Rob, and we will get going with all things primary care networks.
Yeah, thanks, Louise. So just so everyone's aware, what we're aiming to do is come off of camera if we're not speaking, just to free up some space. So as Louise said, my name's Rob Day. I'm a partner at Mills and Reeve. I head up the primary care team there, and have been heavily involved with primary care networks for, well, since their inception. So the first thing we thought we'd look at in relation to today's session is, what really is it when we talk around primary care network incorporation? What do we actually mean, and why should or are primary care networks thinking about doing it? So the starting point in looking at that first question, it's important to recognise that PCNs are not themselves a separate corporate entity or a separate entity like your partnerships are or your practices are. As such, when we're talking around an incorporation, what we are not actually talking about is the moving away from your core businesses into a brand new structure through which you operate. So if we're dealing with a practice incorporation as an example, what that would mean is your partnership, or if you're a sole contractor, your practice as a sole contractor would come to an end, but you would create a new corporate entity into which your business and your core functions would move. That's not the case with a PCN. It is not a separate structure, not a separate body. It's a contractual joint venture amongst its member practices. So with that being the case, when we talk around PCN incorporation, what we actually mean is the creation of a separate provider arm, a corporate provider arm, through which it can support and work alongside the PCN members. So why are primary care networks thinking about it? So we come up with a whole host of reasons, and the reality is these come from the key discussions that we're having both on the legal and on the tax and accounting side as to why people are thinking around incorporating their PCN. So the number one reason that we see at the moment is clearly, and a lot of these I should say are linked, is that it's a useful way, an alternate way to employ your ARRS staff. Now, the reality is that goes hand in hand with the next primary reason, and that is it's a means of mitigating or reducing down the potential exposure for risk and liability for the individual member practices of PCNs. The third reason there, and it goes through, and that's the reason for sort of having a centralised employing body, being the a company which is created. It avoids a situation where there's a divergence of employment terms. Now that can become an issue with many PCNs if you're finding employment being undertaken by multiple different practices within the PCN. So in essence, one practice, practice A, will employ 2 members of staff, practice B another 3, for instance. They will all tend to be on slightly different terms as a result of the individual practices using or utilising their own terms and their own standard terms and conditions to employ them. Next reason is around profit distribution versus retention. So at the moment, there's not this flexibility which is built into PCNs in which they can take a decision as to whether they retain their profits within the sort of corporate structure that can be created. So there needs to be this automatic recording of profits within PCN accounts. This we'll come on to. It can be seen and used as a vehicle through which it can provide support to its member practices. That's not only in relation to what it can do now, so it can provide back office functions, but also it can be used as a vehicle through which future opportunities can be capitalised upon. So there's all talk around the possibilities that the new ICS landscape will create in terms of new contracts being commissioned, certainly at neighbourhood and place level. Well, these corporates could well be a vehicle through which PCNs and their member practices take advantage of those. Sort of linked to the point we made around the risk point, the risk issue, these corporate vehicles that are created have limited liability compared to what we currently face with many PCNs and the practices that are members, which have unlimited liability by reference to their partnership or sole contractor status. And then we have issues which are far more accounting and tax related. So you have apprenticeship levy, and obviously an issue with VAT. So moving on, I'll hand you over to talk around what that VAT particular issue is.
Thanks, Rob. Yeah, this is the dull section of the presentation where there's many slides on VAT here. I thought it would be useful just to go back and have a refresh on the VAT aspect, because I think there's a misconception that if you're a non-dispensing practice, you don't have to worry about VAT, only just applies to dispensing practices. That's not the case, because a medical practice is a business in the same way as any other business, which means it needs to consider its obligation with respect to VAT. Luckily, we have got a VAT expert with us today who's going to talk about VAT later on, and you can direct your questions to at the end. So any business has to consider what it is supplying, what it's selling, and whether that is a VATable supply. And if it is a VATable supply and the income from that exceeds 85,000 on a rolling basis, they must register for VAT. You can register voluntarily if you've got less than that, but you wouldn't probably as a non-dispensing practice. But you do need to consider that registration. Now, the reason why non-dispensing practices are not registered for VAT is that the majority of their supplies are non-VATable. You can't register for VAT if you've got non-VATable supplies alone. So most of your global sum, your enhanced services, your QOF, personally administered drugs would all fall within that exemption. So you only need to consider, or all businesses need to consider, only the VATable supplies. If we can just move to the next slide, please. So VATable supplies broadly come as 0 rated or standard rated. So 0 rated are VATable but at the 0 rate, i.e. you don't charge VAT, and that's where it becomes applicable to register for VAT for dispensing practices, because dispensing over-the-counter goods is a VATable supply at the 0 rate. They don't charge VAT, but they can reclaim the VAT incurred on the costs of the drugs and associated purchases. So if you were a dispensing practice and you weren't registered for VAT, you would be losing out on a lot of VAT that you could get back. Other VATable supplies, which all GP practices will have, are those that are made in you making making somebody else make a decision. So I didn't explain that very well. So things like a character reference, you're not helping the person get better, but you're providing some information to somebody else, shotgun licenses, those kinds of things. So normally in a non-dispensing practice, those would be under the 85,000 annual income for VAT registration, hence why non-dispensing practices don't normally register for VAT. But we do have more non-dispensing practices now having to register for VAT because the size of practices are getting bigger. You know, when practices merge, or you've got super partnerships with several contracts, then obviously that one whole business does breach the £85,000 turnover, or you might have a practice that's specifically providing some other resource or recharges, which is where it can apply to primary care networks. So just moving on to the next slide, this is sort of a demonstration of where we have a problem for primary care networks. So we've got a practice A, who's the lead provider in the PCN. They employ the clinical pharmacist. And that clinical pharmacist works for practices B, C, D as well within the PCN. So practice A is supplying something, a service, to the other practices, which needs to be considered as, what is it? Is it a VATable service? Does practice A need to consider it when it's looking at its £85,000 turnover, assuming it's not registered for VAT? Now, this doesn't apply if the whole PCN is one practice. So if you are a large practice and you are a PCN in your own right, then you're not probably going to be providing services to another business. This is looking at a PCN where you've got one practice who is providing a service to another practice. Even though you're in the same PCN, you are separate businesses. So you've got a transaction that needs to be considered from a VAT perspective. So just moving on to the next slide. The practice A in that example was providing a service. Now, there is a distinction here about sort of a resource. Is it providing a staff and a resource, or is it providing a service? If practice is providing a resource or a member of staff, then as we'll see on the following slide, that is always going to have to be considered for VAT. But if the practice is providing a service to practices B, C and D, then does it qualify for a VAT exemption? Now, there is a VAT exemption where the services are provided by a registered health professional and the primary purpose is maintenance, protection, restoration of the health of the patient. Both of those conditions have to be met, and there is specific note in the legislation for VAT about what constitutes a registered health professional. And with VAT, where there's an exemption, you've got to hit that exemption, otherwise you're subject to VAT. There's no sort of like room for manoeuvre, or it is sort of a medical person, but they're just not on the register. They have to be on the register. So let's then move to the next slide at looking at what may not fit within some of these exemptions. So if you are a practice and you're providing management services, you're writing up the records, you're applying financial services, then clearly that's an admin service. It's not provided by a medical person. It's not for the maintenance or restoration of health. So that practice, if they're dispensing, needs to add on VAT to whatever they're charging to the PCN, i.e. the other practices. Or if they're not VAT registered, they need to keep a record with their other potentially VATable sources on a rolling 12-year cycle to make sure they're not exceeding the £85,000 VAT threshold. Another example, as I've just touched on before, is are they providing a service or are they providing a resource, a member of staff. So under a member of staff, if you're just providing somebody else for somebody else sorry, go back. So practice A, in my example, clinical pharmacist. So if that clinical pharmacist is just provided and is going to be under the control of practice B, you are then providing a member of staff. You're not providing a service. Practice A is not providing that. It's providing a clinical pharmacist that's going to be under the control of practice B. So that would be a vatable service, vatable resource. It's only if you've got a service that's provided by a medical person on the register, or is potentially under the supervision of somebody qualified for that service. So looking at some particular examples on the next slide, I believe, thank you. So obviously as the PCN ARRS scheme extends, we've got lots of different individuals coming in that can be funded. The pharmacy technician is a particular problem because they are not covered on any of the registers. So if you're looking for a VAT exemption for practice A providing a pharmacy technician service, there's no exemption under the medical. It can't be supervised by a clinical pharmacist either, because the clinical pharmacist has to wholly provide their own care. Therefore, that is a particular example of somebody that would have to be charged VAT or considered in the 85,000 registration limit. You've then got social prescribing link workers, health and wellbeing coach, care and coordinators. Again, they are not on the register, so the medical exemption doesn't apply. They may be exempt if practice A was providing them as a service and they were supervised by somebody from that practice A, by the provider. So the control of what that person is doing is by the lead practice providing it. If what they do in practices B, C and D is controlled by practices B, C and D, then they're not being supervised medical service. So again, it's a VAT problem. There is a welfare exemption that may cover some of these services, some of these individuals, but again, we have to look at it on a case-by-case basis. And lastly, the physician associate, again, oh, sorry, just go back. Yep, the physician associate may be exempt. Again, they're not on the register, but may be exempt if supervised by a suitably qualified medical professional. Hopefully, what you've got from this section is that it's not straightforward and can be quite time consuming if you are looking, you know, if you've got a lead practice model providing these members of staff across to other practices, you've got to look at one, is it a service or provision of a member of staff? Provision of member staff, vatable. If it's a service, does it fall into medical exemption? Does it fall into medical exemption by supervision? Does it fall into a welfare exemption, or is that also vatable? So this needs to be looked at on a case-by-case basis, and you need to obviously demonstrate that if you're saying it's covered by a supervision, that it continues to be that way. So then the other problem we now have, which is on the next slide, please, Louise, is the clinical director. So the clinical director position, our original discussions with HMRC was, yes, a CD provides the management and leadership of the PCN, but they're may be exempt by virtue of supervision of the whole provision of a healthcare provided by those GP practices in those PCNs. But is their primary purpose to protect, maintain or restore health? And unfortunately, HMRC do not believe it is, and they believe that VAT should apply to the clinical director position as well. So if you're a clinical director and your practice receives backfill money or payment for your time, then that again needs to be subject to VAT. if you're already registered for VAT, or considered in your £85,000 limit. So I'm going to now hand back to Rob, who will then hand on to our VAT expert, Gilly, so we can just look at some of the solutions to this VAT problem and try and take some of the grit out of it.
Great, thanks Lizzie. So what we thought we'd do is, rather than go too much into the depth of VAT throughout and then cover some of the more higher level points, is take a look at some of the key high level issues that anyone looking to incorporate will need to or wants to discuss. And one of the primary things which is always discussed if there is a decision to at least consider incorporation is what type of corporate vehicle do we use. So in essence, there are 4 corporate vehicles that are available, 3 primary corporate vehicles with 1 as an optional, which is linked to 2 of those. So on this slide, we talk around those corporate vehicles. Partnerships we've added there just to reiterate the fact that they are unincorporated. They have unlimited liability. So what we're looking at is then the following 3 types of corporate vehicle. So the first is limited liability partnerships. As the name suggests there, they're akin to a partnership, albeit that they have separate legal entity and they're a separate legal body. So they're taxed more like partnerships, but they have in place agreements as between its members, which look more akin to what a shareholders agreement would look like for an ordinary company. So next one is company limited by shares, which everybody I'm sure on this webinar will already be aware of. They're the most common type of company in the UK, and they are companies that have a share capital and shareholders. So in essence, what that means is every shareholder will hold a share or multiple shares in that company and will have various different rights depending on the rights attaching to those shares. They have to pay a designated amount, a nominal amount for those shares, but otherwise have limited liability unless they've agreed to offer some form of guarantee. The next type of company is a company limited by guarantee. So that's a situation where there is no share capital, and in essence what you have is membership to the company. So a good example I always use is the BMA. Now that is a company limited by guarantee, in the sense that if you're a member of the BMA, then you will be a member of that company. So in essence what that means, there's no share capital. Everybody needs to agree to pay a fixed amount in the inception of the company, but otherwise it has limited liability. So the 4th sort of corporate vehicle which is mentioned on that slide is a community interest company, and we thought we'd raise it just simply because a number of questions get asked, because there's usually some sort of discussion locally that certainly commissioners are favouring KICs as companies to which they're going to commission services. Now I'm not sure I've seen that in practical terms, but for the purposes of completeness, we just wanted to cover what that actually means. So KICs are not themselves separate legal entities to the to companies limited by shares or guarantee. In essence, you can either have a company limited by shares or a company limited by guarantee, and you can choose whether you incorporate that as a KIC. In doing so, what you're effectively doing is agreeing to establish that company for social purposes. So what that means is you're automatically agreeing to be bound by certain preset restrictions. So those restrictions include, and probably the most important ones include, an asset lock, which basically means that you're not free to do what you want and dispose of your assets. They have to be sold for market value. And the second is something called a dividend cap. So what that means is year on year there's a maximum amount, which is currently set at around 30%, in which you can distribute to the shareholders or the members of the company. So it's okay me rattling on and rattling through the different types of corporate vehicle that are available. What is always then asked is, well, which one should we use? Now, whilst that's a personal choice, what we are seeing is the majority of PCN incorporations have been incorporated as company limited by shares. And there's one primary reason for that, and that is the current GMS and PMS regulations don't allow those types of contracts to be held by companies other than companies limited by shares, albeit there are certain requirements as to who the shareholders are. So with that being the case, whilst most PCNs are not looking at these types of vehicles to hold these contracts in the immediate future, there's a recognition that they may do so at some point in time in the future. With that being the case, there tends to be a move towards the company limited by shares. So moving on to the next slide. What we thought we would do is touch on the pros and cons of incorporation. So now clearly Lizzie's talked through the VAT issues, and we talked around some of the issues at the outset that primary care networks are facing. Well, a lot of these are addressed through incorporation. So the pros, it has limited liability, as we mentioned at the outset. So what that means, providing the shareholders, in this instance the practices, have not agreed to guarantee the company which is created in any way, then the liability of the company itself can't creep back to impact on the shareholders or the practices. So it's ring-fenced. Secondly, it's a separate legal personality, so it's capable of entering into its own contracts, and that includes staff contracts. And by operation of 2P, so the 2P regulations, staff that are already employed by the member practices have the ability to 2P transfer into the corporate vehicle you create. It's a separate legal entity which is capable of providing back office functions, and as mentioned at the outset, it's there and able to secure new opportunities that you might not otherwise look to secure if you were operating as a contractual JV. It's got the ability to retain profits, and it's got the ability to create a cost share group to mitigate the VAT issues which Lizzie was talking about. And Julie will come on to talk around the cost share group exemption in more detail. But we can't lose sight of the fact that there are cons with this, and most people are very good actually at considering and weighing up the cons alongside the pros. Now, the first con has to be the fact that there is obviously the necessity to set up this corporate vehicle. So there are going to be setup costs, be that time, be that money, and also the ongoing costs and admin for running these sorts of corporate vehicles. So any company is going to have annual returns, is going to have annual accounts. So that's obviously something that just needs to be borne in mind and kept on top of. As a company, you're going to have less privacy. So annual accounts are recorded at company's house. Its articles are registered at company's house. So there is a degree of lost privacy when it comes to the terms that apply to your particular corporate vehicle, and also how it's doing financially. The next point is there's a necessity and a need for directors within companies, and they will have codified statutory duties. So that's an important one which is sometimes overlooked. So any directors that are directors of the companies that you create will have a duty to act primarily in the best interests of the company itself. So that can create a necessity for a shift in mindset away from looking solely at the interests of the practice which they represent when they step over that threshold and are actually in a board meeting. So it's an important one to consider for anybody that's looking to become a director of these companies. Depending on the company which is created, there's a need for articles and potentially a need for a shareholders agreement as well. So if you have a company limited by shares, you will always have articles. It's an absolute necessity for any limited company to have a set of articles. But what most companies look to do is also have a shareholders agreement. Now, the rationale behind that is because the articles are a public document. If there's other provisions that you want to keep private, away from public scrutiny, then they can, to a large degree, be put in a shareholders agreement. And the last one, and it's not necessarily a con per se, but it's one which we see more often than not exercising a lot of PCN's mind when it comes to the possibility of incorporation. There's a need to consider some quite substantial issues. So the probably two core ones that I see on a regular basis are shareholdings. So how many shares are going to be held? What rights are going to attach to those shares? So each share has voting rights, capital rights, and dividend rights, and they can vary. So are they going to be equal, or are they going to be weighted in some way, for instance, based on patient list size? And the second issue there, and it's one which does exercise a lot of PCN's mind, is this thing called priority of opportunity. So if there are opportunities in the locality for contracts to be bid for, that are being the contracts that are being commissioned, is it that this company that's being created will have priority when it goes to securing those opportunities, or will the practices still be able to secure and take advantage of those opportunities separately and independently? So in essence, what's that priority of opportunity? Who takes priority? And there's no right and wrong answer, it just needs to be thought through. So moving on, I'll hand over to Gilly to talk about the cost share group.
Thank you, Rob. So to talk a little bit more about the VAT context for cost sharing groups, we've actually pulled on the screen the diagram which is published on HMRC's own website as their example of how a cost sharing group might look. I appreciate it, it looks pretty intense, it's quite a complicated diagram there. Some of the things that you do need to be really mindful of if you think that using a cost sharing group is the way to go for your PCN is to make sure that the members of that cost sharing group are all engaged in the provision of healthcare to at least some extent. So as soon as you start looking at anything or introducing members who are slightly more left field or doing things a bit more entrepreneurially, we need to make sure that they are actually engaged in the provision of healthcare or some other activity which is not subject to VAT. Otherwise, they cannot be a member of the cost sharing group. Also important to note that if you follow through the flow on that diagram to the bottom, you can see that there may still be irrecoverable VAT coming into the arrangements from any subcontracts. Because the cost sharing group is set up as a separate entity, and as Rob and Lizzie have said, is capable of making its own supplies, it's also capable of receiving supplies, so it can buy things in. And those would be subject to VAT in the normal way. So if VAT is incurred by the cost sharing group on things that it's buying in, it won't be able to recover those because it won't be VAT registered as it's only making exempt supplies to its members. So that VAT will get imputed into its costs. So although you won't see VAT being charged back to the members, there will be an uplift in the charges made by the cost sharing group to its members in order to recoup the VAT that it's incurred that is irrecoverable. Setting up a cost sharing group is not something that you are required to notify to HMRC. However, I would strongly recommend that any of these sorts of arrangements are subject to some disclosure to HMRC, probably via a formal application under the non-statutory clearance process. What that enables you to do is go to HM Revenue and Customs and say, look, these are our plans, this is how we think it's going to work. This is a slightly uncertain area of law at the moment, and we would like you to bless our arrangements and put into writing that you agree that the services of the cost sharing group to its members will be exempt and we won't have to charge VAT. That gives you protection. That ensures that provided you've made full disclosure to HMRC, they can't at a later date come to you and say, actually you should have charged VAT or your arrangement doesn't work, and worse, we're going to charge you penalties for not getting the VAT position correct. Set up, if you do choose to use a cost sharing group, is that the risk comes on setup, but also in our experience post implementation. really important that the cost sharing group, once up and running, does take the time to stop and look and check that it's still operating fully within the cost sharing exemption requirements. One of those being that there is a very forensic analysis of its costs and its charges to its members to make sure that they are all falling within the cost sharing group exemption conditions, and there is nothing there which threatens that exemption and would bring in the need to charge VAT to its members. Move to the next slide, please, Louise. Thank you. So as we've said, the cost sharing group has got to be a separate entity, hence why the need to look at incorporation potentially if you wish to use this. The basic premise, though, of the cost sharing exemption is one that came down from European legislation, and although we are no longer in the EU, it has been imputed into the UK law. The idea is to remove VAT as a barrier for collaboration. The way that the UK government has chosen to interpret the requirements of the EU law is that this exemption will only apply to sectors that are in the public interest. So obviously, health and welfare is one of those, education is another, and social housing. We know that the UK government was somewhat reluctant to adopt the cost sharing exemption in the first instance, and we've seen that relatively recently with HMRC actually reducing and the application of the cost sharing exemption and further being more detailed and pernickety with the conditions of when that can and cannot apply to particular sectors. So hence why it's our opinion that it's extremely important to get HMRC's clearance if you're setting one up, because we know that on the whole, they're not a huge fan because there's no VAT being charged. There's no take for the Treasury. The cost sharing group must only consist of businesses carrying out activities which are exempt. So we've said you've got to be really clear that your members are all operating in an exempt VAT environment. It's also got to be the case that the cost sharing group doesn't exist for the purposes of making any profit. And that means that it can only ask for exact reimbursement of its costs from its members. Again, something that sounds relatively easy to achieve, but if you think about this on a really practical basis, it can be quite difficult to ensure that each member is being asked for the right amount and that at the end of the day, the cost sharing group is going to reach a completely break-even position. Lots of implementation advice needed there. It can also only charge its members for costs that are directly necessary to them in engaging in their exempt activity. So it's got to be things that it's providing to the practice members whereby it enables them to carry out their exempt medical or welfare services for their patients. So something that just needs to be brought in the agreements to set it up. We also know that HMRC will take the view that all of the members of the cost sharing group have either got to be receiving or intended to receive some supplies from the cost sharing group. And the way that HMRC have interpreted that is to say that if a 12-month period goes by when a particular member has not received services from the cost sharing group, they would expect that member to have to leave the cost sharing group. So again, something to be thinking about, something to keep an eye on. Once you're up and running, this needs to be checked at least annually to make sure that all of the members of the cost sharing group are actually still qualifying. And it's back to Rob now, I believe.
Yeah, thanks, Julie. So to end with, what we thought we'd look at is some other considerations. So obviously we touched quite heavily on certain points. But when it comes to incorporation, and just so you have these on your radar, if you do go down the incorporation route, these things also need to be borne in mind. So the first of that is if it is employing staff, it will need a separate payroll within the company. It will obviously need to have its own separate bank account, admin functions, etc. There needs to be consideration of the tax implications as a result of incorporating. So in essence, the corporation tax versus the income tax on profits, which currently exists. So that needs to be checked just to understand if there's any negative impact which the incorporation will create. Next is the necessity to check the CQC requirements of the corporate you're creating. Now, when we say check, I would say 9 times out of 10, what we're effectively talking about there is there's a necessity to actually register the corporate that you create as a separate provider for CQC purposes. CQC sort of gave an indication that they would take a bit more of a relaxed view, perceiving this as being an extension to practices functions, but that's now no longer the case. So if you're looking to set up a corporate vehicle, I would have a discussion with CQC in order to determine whether it is that you will need to separately register. If you do, then that needs to be put in place, which can be quite time consuming. Next point is really just to recognise the fact that the corporate vehicle you create will be distinct and separate from the member practices which make up the PCN. So what we mean by that is, yes, the member practices will be shareholders, but there's no direct contractual link between the two. So what you then need to consider is, how do we link the PCN with the corporate that you create? And the reality is there's 2 primary ways that's done. The first is either you update your network agreements and you add the corporate vehicle as a member to your PCN and articulate exactly how the company will support the PCN within your schedules. Or, and this is probably a preferred option for most PCNs, if you create a standalone separate subcontract agreement between the PCN member practices and the corporate vehicle, under which you identify exactly what the company will do, what it will be paid, and what the obligations are on all parties. Now, if you are going down the a subcontract route, so you're looking to incorporate and use the corporate vehicle to provide certain services which the PCN is required to provide under the network DES, then there's a necessity to go to your CCG or ICB, as they're soon to become, to get their, well, not their consent, but effectively there's a requirement for notification. So in essence, what you need to do is notify them of the intended subcontract. That then starts a 28-day period within which they can object if they've got grounds for objection, which are quite, they can only object if there's material risk to patient safety or material risk of financial loss. Now, I'm not aware that any CCG has ever turned around and objected to a subcontract to a corporate vehicle created by a PCN, but never say never. So bear that in mind. Effectively, the notification requirement and the 28-day standstill period. Next point is, well, and this really depends if you're looking to move your ARRS staff away from where they're currently employed into the corporate vehicle, there will be a need to go through a 2P transfer. So you'd have to inform and consult the affected employees, and you'd need to do that long enough in advance of the intended transfer so they're aware of the impact. And the last is you will need to consider the pension status of the company itself that's been created. So as it stands, NHS pensions have allowed these corporate vehicles to apply for what is called a pensions direction. In essence, what they're saying there is, we recognise that it doesn't fall within the rules so that it can ordinarily access the scheme in its own right, but we will, however, give a determination which allows them a time-limited period to access the scheme. Now, my understanding is that access is opened until 2023, and the anticipated sort of fallout from 2023, once it does materialise, is that will be extended unless a more permanent solution is created. But clearly we've talked around incorporation. Are there any other options? And the three ones which are probably quite obvious is there could be a full PCN merger. So the practices come together and merge and bring together their core functions as well as the PCN related activity. You could use a third party, whether that's a federation or a third party provider, to provide certain aspects of the services which you're required to provide under the DES, and they will in turn employ staff. Or clearly you can stay as you are and operate as you are. So that ends the presentation today. I'll hand over for questions.
Thanks, Rob. Great stuff in there. There's only one question that's come through at the moment, but I've been thinking of some questions of my own as we've gone through. So someone just asked if you would have a copy of the slides. Yes, if you at some point after the presentation, we will send out a link to the recording, and you will also have a copy of the slides along with that. So just some questions that I've thought of. Who bears the cost? So if we've gone through and we've assessed some of the staffing that we are providing, and we've come to the conclusion it's a VATable supply, so we have charged VAT. Who bears the cost of that VAT?
I'll take that one, Louise. So the answer in tax is always it depends, I'm afraid, and it depends. It will depend primarily upon the contractual terms that have been agreed between the parties. So whether the price that has been agreed is quoted as being exclusive of VAT or not. And if it has not been said that it's going to be VAT exclusive, then potentially the price is the price and VAT can't be charged on top by the supplier. If it has been stated as a VAT exclusive price, then if the supplier has failed to charge VAT, but in fact should have done, they would be able to then start charging VAT. Now, obviously, there might be commercial conversations to have around that, because that would be an additional cost to the practice receiving that service, but that is the VAT technical position.
So just following up on that, if a PCN was buying in the services of a pharmacy technician or a social link provider, say, from another provider, so not employing that person themselves, the contract should potentially say this is the VAT inclusive price that would cover their risk off?
Yes, that would be our advice if we were acting for the recipient of that service, yes.
Yeah, but if it's within the PCN, so if the lead practice is providing the pharmacy technician to the other practices and charging VAT, it would have to come out of the PCN funds, wouldn't it? So come out
Exactly.
of the admin fund, it just loses 20% of funding effectively.
It does, absolutely. And those are the situations where we've seen other sectors, and I appreciate there are lots of different considerations to take into account, look to TUPE those types of individuals into being employees of the CSG, so that you don't have the addition of VAT on those charges.
Thank you. Okay, we've had a couple of questions come through, so we just need to get everyone's thoughts flowing. So Julie, I think this one might be for you. Is a cost sharing group different even though a limited company setup has been made?
So the cost sharing group, the entity has got to be a separate legal entity. So as Rob was explaining in his table, that will normally be why you look to incorporate it as a limited company. It can, however, be a limited company that all of the practices are shareholders in and not meet the requirements of the cost sharing exemption. So you need to be ticking both boxes, otherwise you'll just have a jointly held company that is charging VAT on its services to its members, rather than one that's also in the cost sharing exemption conditions.
So if the PCN has already created a PCN PCN limited company, you could review that to see if it would meet the cost sharing group requirements, and if so, you can use that limited company that's already set up. And if it doesn't, then you may either need to revise or set up a second PCN company.
Yeah, absolutely. The difficulty, I suppose, and perhaps an additional complication with using an existing company in that way, is that presumably that company has been set up for other reasons, and those reasons might still exist alongside it then also being the cost sharing entity. So it may end up that your cost sharing entity is both exempt in some respects, but subject to VAT registration in respect of its other services, which don't fall in the cost sharing exemption. So it can get a bit more complicated, but it's within the realms of possibility, yes.
Perfect. This is a long question. Apologies if I'm looking away. I've got questions on a separate screen. There appears to be much trepidation for practices to take the lead, which is causing delays in progressing the PCN commissioning plans and thus estate strategies. As with CCGs, can PCNs claim back VAT on professional services when supporting such activities? So I think there's a couple of issues. Did you catch that? Do you need me to say that again?
So I think what we're saying is that reclaim the VAT on professional fees for advising on setup, is that right?
I'm not a VAT expert, obviously, but do CCGs have a specific VAT exemption? I know that primary care trusts used to, and I wonder if that is where that question arises from.
Quite possibly, yeah. CCGs would be a state regulated body, so they will probably be within the exemption for many of their activities, if not all. So I don't know, but yeah, I would expect they'll have that specific qualification.
I think the general answer to that is we've obviously looked at this quite carefully and in detail, as has our Association of Independent Specialist Medical Accountants, who have been in contact with HMRC, and there isn't any specific PCN exemptions. It falls within VAT rules as any other business does, which is what we've tried to explain today, and where there may be a solution with incorporation.
And I think the point around there's trepidation for practices to take the lead, it potentially comes back to the risk, doesn't it, about if you've got everyone on your payroll, the employment risks that you may then attract with that. So again, the incorporation could be an option to mitigate some of those risks. Is that right?
Yeah, I think sometime with the lead provider model, the lead provider is doing potentially a little bit more of the heavy lifting. So a limited company arrangement may share that responsibility and risk a bit wider across the PCN, more in the spirit of the PCN potentially.
Yeah. So can joint contracts of employment help to mitigate VAT issues?
Yes. They're obviously one of those lovely sort of silver bullets from a VAT perspective. However, I'm very mindful that there are other complications that come with joint contracts of employment that may outweigh the VAT benefits from putting those in place. You know, pensions, for example, is the one that jumps into mind particularly. But yes, they work from a VAT perspective.
They don't particularly work from a legal perspective, it's worth adding. Joint contracting is quite a nightmare, and just from a practical perspective, let's step away from the legal perspective. Being clear on who the employer is, what terms apply, if there is a grievance, a disciplinary, who is it that's leading on these things? If there's a claim, who fronts those claims up? And ultimately, you still have at the back end of that the liability that can flow from the employment of those staff. So yeah, it satisfies one of the problems that I think PCNs are seeing, but doesn't necessarily address all of them.
Thank you both. Would a finance director of the limited company need to have a professional qualification in finance? Slightly left field. I don't think you would, is my answer.
I mean, from my perspective, it's if you trust trust them to be able to do the job. I don't think there's a necessity for them to hold any particular qualifications to do that. It's solely a decision to you. It's certainly not prescribed anywhere in anything to do with PCNs.
It's just making sure they've got the right skill set needed to do the job effectively.
Exactly. I mean, it's a good question, because ultimately, I imagine most PCNs are getting to a size now and are probably going to grow again, where these more central managers staff will become more and more relevant. So I can understand the question. It's a good one, but ultimately it's a decision for the PCN to take.
Yeah. I think we have one more question. So one of the pros for an incorporated company was the ability to retain profits, but the cost sharing group suppliers will be exempt from VAT if the group does not exist for the purpose of the gain. So does that mean the company cannot create profits? This was one of my questions. So someone thinking along the same lines as me.
Yeah, that's right. So if, as we said before, you can have a limited company that isn't a cost sharing entity, but if you want it to be qualifying for the cost sharing exemption, then it can only break even. It can't be set up to realise profits. So yeah, that then removes that benefit, I guess, from being incorporated.
So can you not almost ring fence two trades within, just playing devil's advocate, within the limited company? So you have
if you had
transactions with the cost sharing group clearly marked separately.
Yeah, and that's when it gets sort of like to the higher level paper, and it's very complicated to actually manage on a day-to-day basis. But you can certainly have a qualifying cost sharing group limited company that has got both supplies that it makes to its members that are within the exemption, but also supplies to, say, third parties that are not within the exemption. And then it would potentially have to VAT register, and it would be in partial exemption. So for those of you who are already aware of the joys of that, that would then apply to the cost sharing entity as well. It is possible, but it's quite hard to implement and keep an eye on.
Okay. I had thought of a couple other questions which I think we've come across from clients in the past. Will we have to go back and look at anything retrospectively in terms of ARRS funding has been around for a little while now, PCNs have been around for a while. Should we be going back and looking at what has happened since July 2019?
From my perspective, I think the only thing really to look at is where are the where are the staff members employed now, and I think Julie touched on this point when she mentioned this around if you're using third parties to employ any member of the staff, on what terms are they employed? Because if you're looking to claw them back into your corporate vehicle that you create, you've got to be sure that the terms upon which they're engaged at the moment, so you've got these third parties providing the service and the staff, that you're able to do it. So if you're in a term that's for 5 years, for instance, you may well be in breach of contract. Secondly, the only thing really I see people looking back over is their network agreement. But even then, I'm quite reluctant where you create a corporate vehicle to pour over the network agreement and create something which includes it. I'm a big advocate for creating the arm's length subcontracting arrangements, just simply because it usually takes quite some effort to distinguish the corporate vehicle as a separate member, which is not necessarily a core practice.
Perfect, thank you. I think we've got no other questions. Lizzie answered the very important question about where the fish on her wall were from. If anyone else is interested, there is a lady in Mersey, on Mersey Island, who makes and sells them. So I just had one other question just to finish off on. So if we set up PCN Limited Co. and it has its own bank account, could it potentially also hold on trust the funds for the PCN? Because I think we can see a lot of lack of clarity at times on some of our PCNs around the funding that comes in and goes out. So is there a way that to strip that out into the limited company as well?
From a legal perspective, it's one of the things which is usually picked up around what's being paid for the services. So in essence, if there's a desire to move the money which is being flowed into PCNs out to the company, then it's pushed through a subcontract arrangement as the sums which are paid for the services provided. But whether that impacts on VAT, Julie, you may have a view on that.
I'd certainly have seen cost-sharing entities set up that hold funding on trust for their members, and that's fine. And then it's kind of drawn down by the cost-sharing group to pay for their services as and when they're actually charged over to the members. That would work from our perspective.
And I suppose it maybe helps avoid any cash flow delays if the company has got the money on trust that can be drawn down, and the same person administers the PCN bank account as well as the limited company records. It would maybe provide a bit more seamless transaction rather than too many people being involved.
Yeah. And just one other question, and then I think we'll let everyone go. So we've looked at if you are supplying a service or a resource, reviewing the VAT considerations. Some PCNs will have third parties. So for example, you may have a pharmacy technician who is supplied by a third party who perhaps hasn't charged VAT to the PCN. Do we need to worry about what they are doing at their end, or do we just trust if someone hasn't charged us VAT, they've considered it, there's nothing more we need to worry about?
It is one of those perennially thorny issues, because it's for the supplier to get their VAT treatment correct, and that's the stance that HMRC will take. So if they should have charged VAT and they haven't, that is for the supplier to sort out. In theory, though, if they should have charged VAT and they haven't, and they've then realised, what they may do is issue a VAT only invoice, and that go back a number of years, normally up to 6 years. So you might be stuck with a sudden VAT cost being invoiced over to you. So again, it will come down to making sure that the contractual arrangements that are in place, which govern the supply of that pharmacy technician, are stating whether the price is exclusive of VAT or not.
Perfect, thank you. So that covers off all the questions. So it's just gone 2 o'clock. So I would think we will call it a day. If you, as I said, if you do have any questions, please either get in contact with your usual Larking Gowen contact, or if you'd like us to put you in touch with Rob at Mills and Reeve, we can arrange for that as well. But otherwise, thank you very much for listening, and I hope you will have a lovely afternoon.